Good morning, good afternoon, traders. Igor here, MrTopTick.com. Welcome back to the channel. If this is your first time tuning in, please consider subscribing to the channel, liking this video, and possibly share it with someone that you think could benefit from this. Hope everybody's having a great day. S&P is up strong today after cooler than expected CPI data. Today I want to talk about a trade we did in S&P 500. This is what is known as Bear Trap or 112. This trade was set up 38 days until expiration. A little background on this trade. The structure of this trade is pretty simple. We have a long put spread or a put debit spread, and this put debit spread is financed by a sale of farther out of the money naked puts. In this trade, what I did was I bought to open 35.80, 35.50 put debit spread, and I sold to open 2 times as many 3,000 puts. So I sold 20 puts at 3,000 level, and I bought to open 10 of the 35.80, 35.50 put debit spread. I had collected about 9,500, 9,450 or so to put this trade on. So going into this trade, there were 3 possible outcomes. Either the price is above the structure, in which case I just get to keep whatever credit I'd collected up front. We can also be inside of the structure, somewhere inside of the put debit spread and the short out of the money put, which is where this trade actually makes the most profit. So in that case, if let's say S&P at expiration is at 3,400, I have a 30-point wide put debit spread, which is worth 30 points, plus whatever credit I'd collected up front. Let's just round this off to $10. So I have a $30 gain from the put debit spread plus $10 credit that I'd collected up front. So I stand to benefit close to about $4,000 per one contract. I did 10, so max potential profit here was in the neighborhood of $40,000. Now this trade does take up quite a bit of buying power, selling far out of the money naked puts in the S&P 500 or SPX. Does take up some buying power. Doing this trade in a portfolio margin account does help controlling the buying power, and also knowing what you're doing and knowing the risks that are involved in selling out of the money naked options definitely helps as well. I'm going to step through a couple of adjustments that I did in this trade. So with 38 days to go until expiration, I initiated this trade. I didn't do anything until about 2 weeks later. Now we go to October 17th. So this is 13 days in the trade. S&P has actually gone down about 0.5 standard deviation, and implied volatility remained relatively flat. This trade is showing a profit of about $10,000. So I am already at my max potential reward, assuming that price will expire somewhere above my long put spread. We have 25 days to go. What I decided to do, I ended up selling out of the money call spreads for $4 each, and I had sold 5 call spreads that were at around 16 delta. I collected $4 for each, so 5 spreads, $400 each. That's an additional about a $2,000 worth of premium I had collected. So now I have my potential outcomes here are either I'm somewhere between my long put spread and my short calls. I get to keep my original credit, which was $9,000 plus the $2,000 that I had just collected by selling the out of the money call spread. My max potential reward in that area is somewhere around 11,000. Now this adjustment did introduce some upside risk, right? We have a benefit of collecting additional credit by selling out of the money call spreads. In exchange for that benefit, I do have to assume risk being upside risk in the event that the underlying goes above 39.75 in this case, which puts my short call spread fully in the money. The best case scenario is that we're somewhere inside of the short call spread and the long put spread. And then a bonus comes if we are inside of my long put spread and my short far out of the money naked puts. We go forward one more day. So now S&P is trading at 37.56. I sold 5 of the 10 of the long put spreads for $6.80. So I had 10 35.80s, 35.50. I closed half of them. I took in $6.80 for each. What this adjustment did was, we can look at what my trade looked like before making that adjustment. Right, so here we are. This is before making the adjustment. You can look at net delta here is relatively flat, so I did not have to do this adjustment, but the market was pushing higher and it looked like we were breaking out. I was thinking that we might run to test the declining 50-day moving average, which is right around 39.16. 39.16 puts me somewhere here. So what I did was I went ahead and I closed out half of my long put spreads, took in a credit, and that also pushed my directional exposure or net delta from being slightly negative to about plus 13.5. We go forward. This is October 21st. This is 17 days in the trade. S&P is still trading right around 37.25. What I did was I closed another 2 of the remaining 5 put spreads. I collected $7.70 for each. And this turned my delta. This is what it looked like before making the adjustment, right? Again, so last adjustment turned my delta from slightly negative to about plus 13. Another couple of days went by. As the S&P continues to push higher, I continue to lose my positive delta. So now I went from delta plus 13 to only plus 4. I needed to add a little more delta. We can look at the chart and see that S&P still look like it's setting up to run up to the 50-day moving average, which is at this point trading at around 38.86. So to add a little more delta, what I did was I went ahead and I closed 2 of the 5 long put spreads. This turned my delta back to positive 11. We go forward to the 25th. So this is about 4 days later. S&P is now trading at 38.60. We can go back and reference to the chart. We are in fact trading at that 50-day moving average, which is at 38.69. And the S&P is at 38.60. My risk now is to the upside. What I ended up doing, this is what this trade looked like before making that adjustment. Again, I am starting to accumulate short delta, markets moving higher. I need to fix my delta problem. To fix my delta problem, I had removed the remaining 3 put debit spreads. I sold those 3 spreads for $3.40 each. And this is what this trade looked like after making that adjustment. I went from negative 10 delta to a negative 3 delta, which is still not enough, but I don't really have any upside risk, so I can kind of play this game to see if we're going to continue to push higher or if we're going to chop around and maybe fake out and shake out those that are buying the breakout north of the 50-day simple moving average. So this is where I am on the 25th. This is 21 days in this trade, and I have 17 days to go. We go forward the following day. So 1 day later, this is what this trade looked like before making the adjustment, right? We're still at 38.77, looking back at the chart. So we are just north of the 50-day moving average. I have a long way down to my naked puts that are way out of the money. They're at 3,000. So what I ended up doing, I ended up rolling the short puts up from 3,000 up to 3,400. So I rolled my naked puts up 400 points. Obviously, I'm moving my downside risk much closer to at the money. In exchange, I get to collect a credit. I collected $3.45 for each, and I rolled 20 of those short puts. And this, once again, turned my negative delta to positive plus 52. I have much more risk now to the downside. And as you can see, I have now eliminated all of the upside risk that I initially had by selling out of the money call spreads. This is where we are on the 26th. This is 22 days in the trade, and we have 16 days to go. We go forward to, this is November 3rd. This is about 8 days later. And this is what my trade looked like before making any adjustment. Obviously, with 8 days to go, I am in fact sitting right in the middle of my bear trap. Right, so I have a far out of the money short call spread, and I have far out of the money short naked puts. Best case, we expire somewhere in the range between 3,400 and 3,950. And as the market starts to pull back, we can look at the chart, right? So we ran up to the 50-day, chopped around a few days, and now we're back underneath the 50-day moving average. Looks like the market is headed lower. What I ended up doing, I went ahead and I bought one at the money put to reduce my delta from plus 70. I have plus 73 here. Buying one at the money put will reduce my delta from plus 70 to about plus 20. Let's remember, at the money puts are somewhere around in the neighborhood of delta 50. So what I ended up doing, I went ahead and I bought to open one at the money put, which is right at 3,700. I have paid $67.80 for that put. This reduced my potential reward inside the trap, but it did give me a potential bonus if we are somewhere between my long put that I just bought at the money and my short naked puts that are currently at 3,400. We go forward. This is later the same day. What I ended up doing is I went ahead and I closed out the short calls that I originally sold for $4. I bought those back for $1.70. So now I don't have any upside risk. Best case, we are above 3,700. I get to keep whatever credits I had collected. In this case, it's right around the $16,626 or so. Or a bonus for this trade is that if we're somewhere between 3,700 and 3,400, my long puts are going to make money. My short puts are going to make money from the decay of the premium. And this is with 8 days to go. This is November 3rd, 30 days in the trade. Now we go forward to the 8th. This was November 8th. What I did was I went ahead and I bought to close the short puts that were at 3,400. I bought to close these puts for 20 cents each. So I spent about $400 to eliminate any of the downside risk. We were just 2 days ahead of CPI data. Did not want to assume the risk. Is there a chance that the market may fall 10%? Yes. So spending $400 to remove that risk definitely made sense to me. What I did, I bought to close, and that left me in the position where I just had one long put at 3,700. If we were to fall 10%, this long put was going to end up potentially 300 points in the money, which would have been real nice. So this is, I mean, you can call this a black swan hedge. I have no upside risk. I have no downside risk. As a matter of fact, I would benefit tremendously from a 10% decline in the next 3 days. And this is where we are today. Obviously, CPI data came in a little cooler than expected. Market is reacting with a big over 3 standard deviation move to the upside. We're currently at 39.25. So my 3,700 put that I am long is going to expire worthless. This is going to expire tomorrow. It's currently trading for about 55 cents. I don't think it makes any sense to close it out. So I'm just going to let it go. So this trade, all in all, showed a profit of about $16,270 or so. I hope you liked this video. Subscribe to the channel, like the video, share it with somebody. We'll talk to you in the next one.